Well, good afternoon, Michiganders. It is Tuesday, October 11, 2022, and of course, this is Tuesday with Tom, Michigan's only weekly internet show where we do answer your questions about estate planning and estate settlement in Michigan, and we don't send you a bill. As always, I'm your host, Tom Doyle, estate planning attorney, lifelong Michigan resident, and ambassador for all things good in the great state of Michigan. Welcome to today's program, and a special shout out to all of those Michigan Farm Bureau members. Hopefully you have now received information or will shortly be receiving information letting you know that we have a special discount as a Michigan Farm Bureau member. So if that's something that you're looking to get your estate plan done and you're a Michigan Farm Bureau member, check that out on your member website. Well, last week's episode, does your risk of dying increase during a reception? Does your risk of dying increase during a reception? A lot of people think that they can simply wait out the recession or the downturn in the economy and get their estate plan prepared at a later date. So I talk about that in last week's episode. Today's show, we're going to talk taxes. Coming up on the end of 2022, and so the topic for today's show is be sure you understand the projected federal death tax and gift tax rates for 2023 and 2026. But please remember, what I am about to discuss during the program is, as always, for educational purposes and is not intended to be legal or financial or tax advice. You need to work with your attorney and or a tax advisor to determine what is appropriate for you and your estate plan. Be sure you understand the projected federal death tax and gift tax rates for 2023 and 2026. And you might be saying to yourself, why am I going to worry about the federal estate tax rate in 2026? Well, we'll talk about that in just a minute. But death taxes, some people call the federal estate tax. That's what they refer to as a death tax. It's a tax that gets paid as a result of your death. Well, the good news in Michigan is that we do not have an inheritance tax. Some of the states out there do have an inheritance tax. So in addition to the federal estate tax, they have to concern themselves with a inheritance tax. We do not have to worry about that in Michigan. So we're simply going to limit our discussion today to the federal estate, i.e. death tax and gift tax. So let's just start with the federal estate tax. Federal estate tax is a tax that's assessed against an estate based upon the value of your estate at the time of your death. And while it's not a one flat rate, the top marginal rate, which you quickly get to, is 40%. So for our purposes, we're simply going to talk about the federal estate tax rate as being a 40% tax. People look at that and they say, geez, I really don't want my estate at the time of I die. I don't want 40% of that to have to go to Uncle Sam. Well, the good news is under the federal tax code, there's what's called a unified credit. A unified credit that can be applied against the estate tax that you might already owe. That basically means if your estate at the time of your death is not more than the unified credit, then you're not going to have to worry about a federal estate tax being paid. In 2022, which is only a couple more months left to 2022, that unified credit amount for an individual is $12,060,000. $12,060,000. So if you die between now and the end of the year, and your estate doesn't have more than $12,060,000 in it, including gifts, and we're going to talk about gifts that were made that you didn't pay a gift tax on during your lifetime, you don't have to worry about a federal estate tax. Now, question, what is this federal estate tax exemption amount going to be in 2023? Well, normally it's in about November, so we've got about another 30 days or so when the IRS will release information on what the actual rate is going to be, but projections are, because there's an escalation factor based upon inflation, projections are that the rate in 2023 will be $12,920,000. Again, if it's $12,920,000 in 2023, what does that mean? If you die in 2023, as long as you don't have more than $12,920,000 in your estate, including gifts that you didn't pay tax on previously, you're not going to have a federal estate tax due. Now, what is the deal, though, about 2026? Why did I say that you need to understand what's going to happen in 2026? Well, under the current law, that amount that is currently exempt is set to sunset on January 1st, 2026. And when it sunsets on January 1st, 2026, the rate, the base rate, is going to be $5 million. So we're going from a $12.9 million roughly to $5 million. Now that $5 million, there will be escalation on that amount for cost of living adjustments that would have occurred since 2018 when that first sunset provision was put in place. So it's guesstimated at this point in time, the actual amount in 2026 is going to be $6.8 million. So if we use that number in 2026, if you don't have more than $6.8 million, again, no federal estate taxes due, and that amount, that 6.8, will continue to go up over time based upon a cost of living factor. Let's talk about married people for a second. Married people, you have what we call an unlimited marital deduction for U.S. spouses, which means what? You can give your U.S. spouse an unlimited amount of an estate, and there's not going to be any sort of a tax that's due when that occurs. There's no gift tax due when that occurs because you have an unlimited marital deduction. Again, that only applies for U.S. spouses. If you have a non-U.S. citizen spouse in 2022, that unlimited marital deduction is not available. The marital deduction for that non-U.S. citizen spouse in 2022 is only $164,000. Obviously, much less can be given to a non-U.S. citizen spouse, and the rationale behind that is the feds don't want you giving a large amount to your non-U.S. citizen spouse only for them to have it remove it from the United States and never get taxed at potentially some later date. But unlimited marital deduction, spouses can give an unlimited amount of an estate to each other, and there's not a gift tax that's going to be required. Additionally, under the tax code, there is this concept, what's called portability. Again, this applies to U.S. spouses. What is portability? Well, let's look at it this way. I told you that in 2022, the individual unified credit amount is $12,060,000. That means each U.S. spouse in 2022 has a $12,060,000 unified credit. Well, let's say you die in 2022 and you only have $2,060,000, which means you still have $10 million of your unified credit that never got used. Portability means that can now go to your spouse. That $10 million of your unified credit that did not get used can be added to the $12,060,000 that your spouse has by way of a unified credit, which is basically going to now give them $22,060,000. So that's the concept of portability. If you don't use it, or if one of the spouses doesn't use their entire credit, the balance of that credit can be transferred to the other spouse, which basically, for planning purposes, when we talk about it, we look and say, okay, because of portability, in 2022, a married couple in the United States, U.S. citizens, can have $24,120,000 before we worry about federal estate taxes. Again, if we look at that projected $12,920,000 unified gift tax rate in 2023, that portability basically translates into a married couple in 2023 can have $25,840,000 before we have to worry about a federal estate tax being paid. But again, we've got to jump forward. We have to look at 2026 because, again, just like for the individual, that unified credit is set to go down. Portability, basically the double that amount obviously is going to go down too. So we're now, because of portability and the current tax rate that we have in 2022 of $24,120,000, January 1st, 2026, that number will now be, even if we account for what we expect to be cost of living adjustments, in the neighborhood of $13,600,000. So there's going to be a dramatic drop. 2023, that portability of $25,840,000. And again, 2024 will likely be somewhat higher because of cost of living. 2025 will be somewhat higher because of cost of living. But again, come January 1st, 2026, we're going to be taking a significant cut in the amount of the unified credit that's available. If you have an estate that is in any way, shape, or form related to any of those figures, particularly if you have an estate, let's say you've got an estate right now where you don't have a federal estate tax rate, because let's say you're an individual and you don't have $12,060,000. But if you look at what you project your estate might be in 2026, there might be an estate of some $6.8 million at that time, then you might consider what planning options you have now, looking at how do you save, if you will, a $12,060,000 credit that you have today when it sunsets to $6.8 million. Is there a way for you to save that credit amount that you're now basically going to be losing because of a reduction in the unified credit? And the good news is this: the IRS has, through its rulings, clarified that an individual who takes advantage of that current higher unified credit rate isn't going to be adversely impacted after 2025 when the exclusion amount is set to drop to those, again, pre-2018 levels. So what does that really mean? That means you have planning options. You have planning options to protect that amount that exceeds what's going to be that unified credit in 2026. Same thing for spouses, okay? There's planning options for spouses. So if you're looking at the possibility as a married couple that in 2026 the estate is going to exceed that guesstimated $13.6 million. There are planning options today between now and 2026 that you might want to consider that would allow you to protect or save, if you will, the current higher unified credit so that that would still be available after 2026. But you're going to have to plan for it. If you do nothing, if you do no planning, you're basically giving up that higher credit that would be available to you. So think about this. Think about it another way. December 31st, 2025. Roughly, and I'm guessing here now, an individual's probably going to have in the neighborhood of about a $7 million federal estate tax exemption is going to have roughly, and let me go back and even look at my own numbers, is going to have roughly a $13 million federal estate tax exemption on December 31st. If they do nothing, then on January 1st, that drops to $6,800,000. A significant drop in the unified credit, particularly when you consider it's a 40% tax. Married couples, again, think about it this way. December 31st, 2025, you're going to have between the two of you roughly $26 million in federal estate tax exemption. But if you do nothing and you've done nothing to protect it, one day later, that's going to drop to $13 million. So essentially, you're going to lose half. Whether you're a single person, married couple, you're going to lose about half of the unified credit that's available to you. And you're losing about, you're not going to get that credit, which then means that that amount is going to be taxed at a 40% tax rate. So what options? If you're looking ahead and you're starting to plan ahead, and 2026 is going to be here before you know it, you can start looking and say, well, okay, what can I do? What should I be thinking? What possibilities are out there that I might be looking at between now and January 1st, 2026? Well, one is using gifts. Using gifts. When they talk about a unified credit amount, they're talking about gifts and federal estate tax. So let's talk about that just 1 second on gifting, and then you'll come back and see how it works. You probably are all familiar with the fact that there's a certain amount of money that you can give anybody any year, and you don't have to worry about gift taxes on it. And currently in 2022, that amount is $16,000, which means what? You can give anybody that you want to $16,000. Whether it's cash, investments, real estate, other assets, doesn't matter. As long as you don't give them more than $16,000, you don't have to report that to the IRS. In 2023, again, because of cost of living adjustment, it is expected that that will probably go up to $17,000. So, a lot of clients will, in order to shrink the size of their estate, so that there's not as much in their estate, will consider implementing a gifting program where they start every year giving away $16,000. And there's a lot of different ways to do that. And if that's something that might be interesting to you, it's certainly something we can talk about, or you should talk to your tax advisor. So it's using gifts to shrink the size of the estate. Why? Again, because the gift tax is a 40% tax. So you're still trying to save that 40% tax, whether it's federal estate tax or gifts. So you start making gifts. You give $16,000 a year. Married couple, between the two of them, can double that amount and give $32,000 a year. So let's say you've got 4 children. You're giving them $32,000 a year between each spouse for the children. And over time, you can give them a significant amount of money that will shrink the size of your estate. Well, what you can also do, though, is you could, because it's a unified gift, a single person today could give away $12 million. Now, it obviously exceeds the $16,000, but because it's a unified credit, what happens if you give more than the 16? For example, what would happen if you gave away $12 million to somebody today? Well, the first thing that you'd have to do is you'd have to file a gift tax return when your income taxes return in April. You will have to report that gift to the IRS. The good news, though, is you can make an election when you file that gift tax return. You can either say, okay, I'm going to pay the gift tax on that amount right now, and you're going to take the $12,060,000, subtract 16 out of that, and you're going to pay a 40% tax on that difference. Most people clearly don't want to do that. So option 2 is to say, I'm going to defer the gift until I die. What does that mean? That means when you die, what's now going to happen? When your estate is settled, the person in charge of settling your estate is going to look and say, okay, this person had a $12,060,000 gift that was made back in 2022 that they did not pay tax on. They deferred it. So now we're going to have to apply the unified credit that's available at that time against your $12,060,000. So you've kind of got this $12,060,000 out there. Let's say the unified credit. Let's just pick a number out of the air, and let's say that unified credit is now. Let's say you do this in 2022 when the credit amount is $12,060,000, and you die in 2023. We're already projecting that the amount of the credit is going to be $12,920,000. So if you take the $12,920,000 credit that would be available to you in 2023, subtract out the $12,060,000 that you gave away in 2022, you still have a credit amount remaining, roughly just shy of $900,000, which means what? You won't owe, or your estate then won't owe any federal estate tax unless, in addition to that credit, that gift tax amount that was never paid, you have additional assets that would cause you, between the gift tax amount that you never paid tax on and the estate that you owned at the time of your death. But just assume you gave away your entire estate in 2022. So you had no estate in 2023. As long as you filed your gift tax return with the IRS, then there would not be a tax due at the time of your death, which essentially means you could use gifting as a way to give away in advance, if you will, that unified credit. So some clients are going to look and say, well, beyond the $16,000 a year, I'm going to start eating to my unified credit. Now, you don't have to do all of it, but it is an example of a way that you can actually give more than $16,000 and take advantage. Why? Because the IRS again says that when the number drops back to that lower number of roughly $6.8 million in 2026, if you've already given it away and you've already filed the federal estate tax return and you're already planning on using that amount towards unified credit, you've essentially protected that amount and it will be available to you at a later date. So that's an option. Another option, and these are kind of going back, a lot of clients haven't really worried about these sorts of planning options once the federal estate tax exemption amount had gone up. But another option is, let's say you're calculating and you're figuring out what that gift tax is likely, or what that federal estate tax is likely going to be at some time in the future. Some clients will buy life insurance. They'll buy life insurance. Why? So their estate has the liquidity to pay it. That oftentimes is something, for example, a small business owner or the farmer whose primary asset of the estate is land or is tied up in their business. It's not readily sellable, and they don't want to have to force a fire sale of their business, or of their farmland. So those clients will sometimes go out and say, well, why don't I go buy some life insurance? Create the liquidity to pay the tax. I'm not going to give stuff away because I don't want to do that, but I want to make sure that I have enough in assets when the federal estate tax drops back down that I've got the liquidity to pay the tax. So buying life insurance. But when you buy life insurance, and I've had other episodes of the program on this, what you don't want to do is go out and buy life insurance in your name, because if you go buy life insurance in your name, all you're doing is increasing the size of your estate, because the amount of the life insurance is now going to be calculated when calculating the value of your estate. So what you do is you set up what's called an ILIT, an irrevocable life insurance trust. The ILIT buys the life insurance policy. If it's done properly, because the ILIT bought the policy, it is not considered part of your estate. It doesn't increase the value of your estate, but the proceeds upon your death that get paid to the ILIT can be used to pay the federal estate tax that's otherwise due. So buying life insurance is going to be something that a lot of folks out there are going to start looking at again, who maybe hadn't been worried about it for several years. Another plan. Let's say you have a current life insurance policy. You're not buying a policy. You have a current policy. Well, you can transfer a current life insurance policy into an ILIT. You can do that. What you need to be mindful of, though, when you do that, and we're going to talk about simply term insurance, because if we've got whole life insurance, we've got some other tax considerations that have to come in. But looking at a whole life policy, looking at a simply term policy, if you transfer a current term policy into an ILIT, what you need to be mindful of is that really doesn't do you any good for 3 years, because there's a 3-year look back. So here we are in 2022, almost the end of 2022. So if you transfer a current policy into an ILIT, and you do that in 2022, that means until now in 2025, you better not die. Because if you die, that transfer didn't protect the life insurance from being calculated into your estate because of that look-back rule. So if you're going to use existing policies, you need to take into consideration that look-back rule. And one of the things that overall you need to think about, and this is something that you need to talk to your insurance agent about, is when you're looking at insurance, obviously you're going to get into questions of insurability. Maybe you're insurable now, but if you wait a number of years to create an ILIT and to buy a new life insurance policy, maybe you're not going to be insurable then. So prudent planning might say, well, get the policy now, get the ILIT now while you are still insurable. Or maybe you're not insurable now, and that is the reason that you can only look at transferring a current life insurance policy into an ILIT. You still have to be mindful of that 3-year look-back rule. Now, the other consideration that underlines all of this, and I had mentioned it, I think, back before the Biden administration took over after they won the election, is will Congress and the White House lower the credit amount? Or will they increase the credit amount? I mean, Congress and the White House could, in theory, between now and January 1st of 2026, look and say, hey, that $5 million that is going to go back when the law sunsets, we're going to lock that in at a higher rate. We're going to increase that rate. They could do that. They could also, though, reduce it. They could look and say, hey, maybe we've got, $31 trillion in debt, whatever that number is. Maybe part of a tax proposal that's going to come out would be to, in fact, reduce the $5 million to something lower. And in fact, when President Biden was running, The proposal that the Democratic Party was working on at that time was to reduce the exemption rate to $3.5 million, meaning not $5 million, meaning $3.5 million. And there's a lot of folks out there who might not have a federal estate tax problem at $5 million that in fact would have a federal estate tax issue at $3.5 million. And the proposal, at least on the platform for the Democratic Party back then, was to then increase the top tax rate from 40% to 70%. So if that were to play out between now and January 1st of 2026, not only would the federal estate tax rate go down, or exemption amount go down, which means less is protected, it also means that the tax rate goes up, meaning the unprotected amount is going to be potentially subject to an increased tax rate of 40% to 70%. So you need to understand the numbers, all right? And you need to be sure you understand them so that you can relate that to your estate. What is your estate now? If you're married, what's the joint estate that the two of you have? What's it projected to be in 2026? Okay. Probably not so much what's it projected to be in 2023. It's more that what's going to happen in 2026 when the unified credit is scheduled to go down, meaning there's less that's going to be able to be protected, and what planning options do you have? So you really need to start thinking about those planning options now. I think prudent planning would be to do that rather than waiting to suddenly have your estate subjected to a significant tax rate that otherwise could have been avoided. That's why you need to be sure that you understand what the projected federal death tax and gift tax rates are, not just for 2023, but for 2026 as well. Of course, Amanda and I would be honored to have the opportunity to help you in putting together your estate plan to protect your loved ones, or perhaps amending a plan that you already have in place, or assist you in settling a loved one's estate. Head on over to our website, doylelawpc.com. If you are a prospective client, click on the scheduling a consultation, that link that you're going to find there for prospective clients. You've got the ability to download our estate planning guidebook, schedule an initial consultation with us, and as a result of that consultation, we'll be able to advise you as to what options you have for planning your estate. Obviously, too, if you have a significant sizable estate, it would be prudent to talk to your tax advisor in the meantime about your tax situation and how these changes in the federal estate tax law might impact that planning that you are going to incur in. If you're a current client, if you're looking at updating your plan, simply go again to the website, go to the virtual office. There you're going to find the Update My Plan service where you can tell us, hey, Tom, Amanda, this is a change that I'm thinking about making to my plan. What's it going to take to make that change? And then we'll get back to you about what documents have to be changed in order to make those changes. And we'll decide, do we need to have a consultation about that, or is it something that we can simply handle through email and mail, etc., and what the cost is going to be of making those changes. As always, too, we still have our legal store available to you. If you're just looking to have an individual document prepared, maybe all you need is you're a trustee of a trust and you're looking at selling real estate and you need an updated certificate of trust, simply head on over to the legal store and you can order all of that online as well. Something else that I should at least mention at this point in time, if you do go to the website, the other thing that you're now going to find on the website is our seminar schedule. Amanda and I have a number of seminars scheduled between now and, quite frankly, Thanksgiving, where we're going to talk about estate planning. Amanda's going to talk about estate settlement issues. So if you're looking for information about that, or you have friends or family who are thinking about getting their estate plan together, or might need some assistance in settling your estate, simply go to the website and click on the seminar link. That's going to show you what seminars are available, and you can pick the time and date. They're basically being offered at this point in time for webinars, but we would love to have you join us for any of those webinars so that we can answer the specific questions that you have about those issues. Well, I think that's going to be it for today's show. As always, though, if you have a comment about the program, a topic that you'd like to have me discuss, questions that you'd like to have answered, please send me an email, tom@tuesdaywithtom.com, or mail me a postcard, Tom Doyle, P.O. Box 3752, Grand Rapids, Michigan, 49501. And as always, we invite you, please follow us on Facebook and Twitter. That would be Tuesday with Tom. Follow The Office on Facebook and Twitter at Doyle Law PC, and invite your friends and family to do likewise. Remember, too, Tuesday with Tom is available on a number of podcast services: Apple Podcasts, Spotify, Google Podcast, iHeartRadio, Spreaker, and many, many others. Perhaps wherever it is that you listen to podcasts regularly, you're going to find Tuesday with Tom is available there. And you can always ask your smart speaker to play Tuesday with Tom as well. Well, thank you again for spending some of your Tuesday afternoon with us today. As always, I hope that you have an awesome day and an awesome week in Michigan. Stay safe. Tuesday with Tom has been brought to you by the estate planning attorneys at Doyle Law PC. To learn how we can help you with your estate plan or with settling a loved one's estate, please call us today at 517-323-7366. That's 517-323-7366.